The economy as it currently is, knowing they're going to provide forecasts of how they expect the economy to look down the road. What is your expectation in terms of revisions we could see to growth estimates and inflation? The economy as it currently is, knowing they're going to provide forecasts of how they expect the economy to look down the road. What is your expectation in terms of revisions we could see to growth estimates and inflation?
One day they're on,
the economy as it currently is, knowing they're going to provide forecasts of how they expect
for businesses to plan. We are already seeing indications that this is affecting manufacturers. There's a recent survey in New York State that indicated a sharp decline in business expectations among manufacturers there. So all of that does indicate that the tariffs could be having, the chaos could be having its, I don't know if it's a desired effect, but the effect of making people think twice about what kinds of investments they're doing right now and kind of holding back, waiting for the chips to land and to see where this administration will go. I think, on the other hand, from the consumer side, you're seeing consumers getting increasingly anxious. Their expectations are souring. They're expecting more inflation. And again, that makes the Fed's job incredibly difficult, because if they continue to see expectations of higher inflation alongside investment slowing or people sitting on the sidelines as we wait to see what the administration will do, that's not a great situation for the economy.
Heather, you mentioned the dual mandate. I wonder to what extent you expect a change in language to reflect expectations for a rising unemployment rate. Tariffs, one thing, DOGE is another. And at some point, we're going to see the cumulative effect of these federal worker layoffs. What will that say today?
That's not a great situation for the economy. Certainly. And DOGE is
Heather, you mentioned the dual mandate. I wonder to what extent you expect a change in language
having lost their
to
jobs.
reflect
That is certainly an important piece of the puzzle. But then it's
for
also
a rising
important for all of the things that those
Tariffs, one
workers
thing,
used
DOGE
to
is
do
another.
that are now not
And
being
at some
done,
point,
that
we're going to see the cumulative effect of these federal worker layoffs.
Think about that. That's not a great situation for the workers who have been dismissed, who were in charge of the Canadian
I wonder to what extent you expect a change in language to reflect expectations for a rising unemployment rate. Tariffs, one thing, DOGE is another. And at some point, we're going to see the cumulative effects of these federal worker layoffs. What will that say today?
It's not a course which the workers who have been team of economists to do all that work.
I wonder to what extent you expect a change in language.
Cases coming down the pipeline. Will those workers be reinstated? What will we see moving forward? Again, this all makes their job that much more difficult, and I think that the chair will remain, as he has already said, that the fundamentals of where we are, and of course the economy that the president inherited was quite strong, and we're not seeing the kinds of downturn in the data yet, but I'm sure he will express some caution about what's to come.
Well, and when we consider that caution, it was described by Mohamed El-Erian, who, of course, is a Bloomberg opinion columnist, earlier today with some of our colleagues, as being a question of if he's framing the potential of future cuts down the road as good cuts because progress is being made on inflation versus bad cuts, which is easing policy because things are going south in the economy. How difficult is that line to walk?
Well, what we saw in the first Trump term, when he raised tariffs and that raised prices, the Fed had some room to maneuver because we did not have the legacy of the inflation that we have now coming out of the pandemic. So now they are still working to get the inflation rate back down to their target rate, and at the same time, the tariffs are likely to raise prices for consumers. But they're also seeing people cutting back. Again, with DOGE, you're seeing, these effects on employment. So, the word that I think people are going to start wondering about again is this word stagflation that we were all, of course, talking about at the end of the first Trump term. That was the word on everybody's lips. That's where we were concerned about the economy being.
What will Jay Powell say about stagflation in our remaining moment, Heather? He's surely to be asked about it in the news conference.
I'm guessing, and I don't know, I don't have a crystal ball, but I'm guessing he won't say the word. I'm guessing that he will continue to, indicate that, because they rely so heavily on the data, that the decision that they are making today is about the data that's already, in check, and they will remain cautious about where things go down the road.
All right. Well, he definitely has a tough road ahead of him just about an hour from now. Heather Boushey, thank you so much. Former White House Council of Economic Advisors, member during the Biden administration, now at the Harvard Kennedy School. We appreciate it as we're counting down here to that decision less than half an hour from now. And the dot plot, especially, as the market is very likely to be paying attention to whether or not cuts are going to materialize in a more material way this year than was expected even just a few months ago.
Just to set the baseline here, watching the markets before we get into our special coverage, we're going to kick things to New York in just 1 minute with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. The S&P 500, Kaylee, up 24 points. Not a huge rally, but holding positive today. The 10-year yielding 4.31%.
Yeah, so we'll see how the market actually moves off of this. Keeping in mind, as you quote, where the 10-year yield is right now, that has come down substantially in the last several weeks. And an argument that this administration had made that you don't need the Fed to cut rates to bring rates down and mortgage rates along with it, that other policy could do that job. And maybe we've seen a little bit of that materialize.
That is the message from Scott Bessent, that's for sure. We're bringing the 10-year lower, doing the work for the Fed. With Kaylee Lyons, I'm Joe Matthew. We'll meet you back here 5 p.m. Eastern Time on the late edition of Balance of Power. Special edition of Bloomberg Surveillance. The Fed Decides is on the way next, right here on Bloomberg TV and radio.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of
What's
with
going on,
Jonathan
guys?
Farrow, Lisa Abramowitz, and
so
Tom Keene.
we all should be aware what we're going to have
Bloomberg
coming up is
Surveillance.
this
The
Federal
Fed
Reserve rate
decides.
decision.
Live on
Did
Bloomberg
any of you
TV
guys
and
taking
radio,
any trades
counting down to
before
another
the rate
Fed
decision? I see a few of
and
you took
Chairman Powell
advantage
news
of
conference.
equities
That
on
decision
that rise to the
27 minutes
upside.
away.
Yeah, good job.
Alongside Lisa
So you
Abramowitz
guys
and
that
Tom
took
Keene, I'm
advantage of
Jonathan
that.
Farrow. This Federal Reserve says they don't assume,
Yeah, that was mostly
speculate
due.
or guess a little bit later.
I have a feeling
Will
that
they
was
do
really due
just
to the
that?
headlines
their
that came out with
projections for
Zelensky
how
and
they
Trump.
see inflation
So that
growth
was really,
going
really good
forward.
trades.
A
and we took
question of how
advantage
much
that.
they will reflect what we
But
hear
what we're going to be
across Wall
focusing
Street,
on,
which is
you could
firms
just see that
collectively
equities is
downgrading their
recovering,
expectations for
because
growth
now the
and
markets is setting
upgrading their
up for this
expectations
rate
for inflation
decision.
to be at a similar tone from the Federal Reserve.
TK, this
So
is
let's
a
just get
three-part
right to
act,
it,
a
guys.
news conference at 2:30 Eastern Time. Before we get
Read the
there, a
questions and
non-decision
stuff.
in the minds of many. But those forecasts will be keenly watched.
Yeah,
The
man.
forecasts will be
Good
really
job.
interesting, and I'd
dude.
sum together inflation and real GDP. I like what Ernie Tedeschi and Martha Gimbel say at the Yale Budget Lab.
So a majority of you
Quote,
should have an
"Things are
idea
getting weird."
with
That's
what to
this Fed
expect
meeting's about.
for
Let's
this
talk
rate
about that
decision coming
weirdness.
up.
Downside risk to growth.
So this one,
upside
we're
risk
going to
to
have
inflation.
the
Are they
dot
worried
plot.
about
The
one
dot
or the
plot
other
is going
or
to
both?
be
And can they
pretty much
really
the main
have
focus,
a Fed
right?
put
What
on
is
markets at
how
a
is
time
rates
where
going to be
potentially you
projected
have this
moving forward from the
inflationary
Feds?
light type of mix?
You could already
We've been
see
talking
moving
about
forward
is the Fed
the
put in
markets
action?
hasn't
Is
been
the
really
Trump
paying
put in action?
attention
Is the Fed
to the
put dead? And I
Fed's
asked
to
that in a
monetary
way that the
policies.
market
It's
has
been
traditionally
reacting
known
to
it, where they can
sentiment. It's been
rescue
reacting
markets
to
by signaling a more
what
dovish stance.
Trump's,
Does that
you know,
have
tariff
the same
wars
ramifications for a
is
market
impacting
that
the
is
markets,
pairing
right?
off with
So
both
the
growth
uncertainty
risks as
there
well as
is most
inflation risks?
likely
Let's check out this market.
going to
Equities
lead
right
the
now,
Federal
the S&P
Reserve
500
today.
just a touch firmer going
The
into
news
this
in the
decision
background
at
is
2 p.m.
probably
Eastern Time. We're higher by
your end.
0.5%. And this bond market just can't get away from 430. Will that change in the next few hours? Your 10-year.
Put it there. You can hear me now? Test, test. Better, better. All right, great. So what's all right? So where was I? Yeah. So the Fed, pretty much the Feds is going to be in a cautious, data dependent approach because of tariffs. So most likely we're just going to see the Feds pretty much just stay the same. Most likely it's going to be a pause. We're probably going to see everything remain the same because it's not April 2nd yet. Tariffs hasn't been implemented in the markets yet. So there's just a higher probability there's no actual change. So it's understanding that it could cause a lot of volatility in both sides. But what I really feel that's going to give us the best tradable opportunity, right, is right here. It's those projections, right? So the one the current is what's going on this year, the first year, the second year, 2026, 2022, 27 and longer, right? So this is what's going to be really the main focus is the projection. The markets may react to the projections right away, and then we'll probably see a bit of a recovery because now we're going to be focusing on, Powell's forward guidance. That's going to probably how the markets react pretty much. And you know how he is for you guys that we trade this all the time. Typically, he really likes to not really give us anything, right? He likes to stay very neutral. So he's going to probably be data dependent, not give us anything, but depending on how these numbers are, that's probably where we're going to get our best tradable opportunities. All right. So we have to be prepared for that. So if we're looking for a dovish outlook, which is the markets has been anticipating it, but the Feds hasn't really confirmed it yet. But most likely this meeting, we're going to get a hold. They're going to pause rates. But God, if they surprise us with a cut of 25 basis points, right away, dovish reaction, weaker dollar, stronger equities. Okay. But most likely they're going to give us a pause. If they pause rates, we need to see dovish forward guidance. And with the dovish forward guidance, we need to see the dot plot signaling more rate cuts in the future, just a lower projection of rates, along with growth expectations lowering as well. And the forward guidance is just really signaling more of an aggressive approach towards rate cuts. Okay, so that's how we're going to be able to take advantage of a weaker dollar and stronger equities for this event. And most likely gold would do the opposite of the dollar. So this is the reaction we've been getting without the Feds confirming it. But if we want a hawkish reaction, most likely it's going to be a hold, but we need to see hawkish forward guidance. And the dot plot has to either remain the same, right? So meaning that the projections that we have right here, the previous, either it remains the same or we see that the numbers are higher than the previous, right? And then we want to pay attention to like growth and like the labor markets as well. I didn't put labor too, but we want to see if the labor markets is still strong and growth is actually increasing. And the forward guidance, pretty much they're still going to cut rates, but the forward guidance needs to be more in a gradual approach. All right. So that's what we're going to focus on. And I pretty much put the wrong one. So if we see that we see stronger growth, forward guidance has to be data dependent and they're going to be at a gradual pace. So that's what we're going to focus on for a hawkish outlook. And if we get a hawkish outlook, it's going to be stronger dollar, right? It's going to be bearish for equities and gold. But when we're trading this rate decision, guys, whatever asset you are focusing on, there's going to be little things that you have to pay attention to that individual asset. All right. 1 second. All right, I'm back. Yeah, dogs are acting crazy. Yeah, so strong dollar, gold sales, exactly. So that's what we're going to pay attention to. So, but when you're focusing on that individual asset, right? Say we're going to start off with equities. And I want you guys to focus on equities, right? So whatever you're trading, NASDAQ or S&P, when we're trading this, what's going to be more important is expectations on growth, right? Obviously, the best option for equities is if we get more rate cuts, right? We get a dovish outlook for the Feds, plus growth expectations are still strong, right? Because growth expectations is supportive for the stock market. So if we see that the Feds is signaling stronger growth, even regardless, that's the reason why in here, let me show you guys. I said, pay attention to be cautious with equities from this event because we could get whipsaw price action because we're having we're having like double-sided information. One that is for monetary policy and the other is for growth. So we could see whipsaw price action. So with this event, you want to be able to take advantage of a clear opportunity. So if you're trading equities, what is the best opportunity? It's going to be if we see inflation numbers are lowering. Why? Because that signals more rate cuts to come, right? That's positive for the stock market. But if we see growth numbers are actually increasing, right, in the projections, that's also going to be supportive for the stock market. So even if we do see an example, if we see that the expectations of inflation is lowering, but they're also lowering expectations for growth, that's probably going to be the reason for the whipsaw price action on equities. But that could also cause equities to fall because of those lower expectations of growth. So you most likely want to focus on that. But the easiest opportunity, lower inflation, stronger growth numbers, that would support upside. But say if we have inflation that remains the same or inflation numbers that come out higher, right? If we see that inflation numbers come out higher, the rate projections are the same, or rates are looking to cut less rates, right? Like weaker growth, higher rates is going to be bad for equities. But weaker inflation, stronger growth, good for equities. Okay. So weaker growth, bad for equities, higher rates, bad for equities. So that's what you're going to have to focus on for this event. All right. So when the data comes out, just be vigilant of that, because it's going to be tough for me to like follow everything. But when you're trading the currency, I just go over expectations, like the possible trade ideas for equities right now. So at least you can have areas of market structure to really focus on, so you could take a trade. What equity pairs you guys going to trade? Mostly NASDAQ and US 30, right? I assume none of you is really looking at S&P. So I'm not going to really cover it, but I'm pretty sure US 30, NASDAQ is pretty much the main ones you guys focus on. Yeah. US 30. Yeah, I'm put that right there so you guys can see the reactions. It's going to be right here. The dot plot is right here. It's the projections is right here. All right, Wayne. So we're going to see it here. That's the beauty of this. We got it right here. That's what I was saying, like, because I didn't check it at first. I was like, oh, fuck. It's going to be tough if I got to read through all those headlines just to see, like, the projections. But, yeah, it's cool. That's the benefit of having this. You get to see the numbers right away. But even, you know, there's a lot of algorithms that come in place. So when I'm telling you guys about volatility, right, we're probably going to get obsessive volatility because it's just we're not quicker than algorithms. They're going to get that. They're going to get those numbers in milliseconds, right? So the reactions could be pretty big, but wait for breaks of structure, and that's what's going to give you proof that the market is going to actually forward in that direction. All right. So that's what we have to really focus on, is that gold, again, the best option, I feel like, if you're trading gold, it's tough now, because before, if this was like last week, buys all day. Buys all day. But now that we have de-escalations coming in place, this could be a real reason for expectations. Like, this could be a real reason for gold to start lowering in price. If we get a hawkish reaction, those sells will probably be one of the best bets. You know, we could see a break of structure, but just take it as a scalp, right? Because we just don't know how forward guidance is going to be with this event. So you just want to be cautious with trading gold. But for this event, I do expect gold to do the opposite of the dollar and the yields. All right. So this is my first time watching MC. Yeah, welcome, man. You've been killing it too. Are the NAS numbers same as futures? Most likely no, but the price action should be the same. Like, because if you're looking at futures, the price action should be the same. All right. But the numbers is going to be different. That's why I just draw the areas of structure. So at least I know the price action, and then put it in your chart. So when you get a break of structure, you know, once we get a confirm of a direction, you're going to be able to take advantage of it. All right. Yeah. Like, you guys that trade futures, the numbers are different, right? I know 100% the numbers are different. I don't even have to ask. Like an example, if you're trading futures and you're trading the dollar, you probably could, if you could trade DXY, that's a benefit. You know, like you could trade DXY itself. You don't have to trade like UJ or Euro USD. You know, you could trade just that individual pair. And just for you guys too, man, if you took advantage of good opportunities earlier, you don't have to trade this event, you know, because chances are there's going to be plenty of opportunities afterwards. I'm currently expecting like today to be just like whipsaw price action or dud or just a dud. But that's how I'm expecting today because nothing really has changed. It's nothing that happened so far since December's dot plot, right? So I'll just show you guys here. If you guys are paying attention to the central bank tab, right? So the previous dot plot, this was, we're gonna see these expectations change, right? So obviously we're gonna be having, this is the past, we're gonna see what's gonna happen next, but this is the dot plot. This was December's. So if we see the numbers look like September, that's obviously dovish reaction, weaker dollar, stronger equities. If we see that it kind of looks the same like this, or we see it higher, right, then we're going to get that hawkish reaction. So that's how the dot plot is going to look, you know, moving forward. But nothing really has changed when it came to monetary policy yet. You know, inflation, growth, labor, we're starting to see overall like weakness in the labor markets. We're starting to see that weakness, but nothing is really drastic to a point where we should be really expecting, you know, like a dovish Fed from here on out. We haven't had anything really supporting that yet. So that's the reason why. And plus tariffs is just causing uncertainty. So that's the reason why, you know, not really expecting much from this rate decision, you know. I know when I'm talking a lot, I'm gonna be coughing, guys, so don't mind me. How do you take the BOJ earlier on the? Yeah, I didn't trade it. From the reactions of looking at the yen, it looks like nothing happened. So I'm glad I didn't stay up for that shit. It looked like nothing really happened, and I had it at, like you could kind of tell moving forward. You know, when it comes to economic data, like the Bank of Japan, it was no hawkish inflation data. No dovish inflation data. Data has been pretty stagnant. So that's probably why nothing really changed from the BOJ perspective. You know, I didn't really felt like trading it. But remember what I told you about the timing of it sucks. Like I think they released it around like 10:30, like 10:46 or some shit. So that's another thing too, is hard trading those Bank of Japan rate decisions because it's so random. But focusing on like UJ, I'm gonna focus on that today. Because the yen is going to do the opposite of the dollar and the yields. Well, it's supposed to. So I'm not expecting the rate decision, however that went, to impact the yen. But you typically like these type of events, I really like to focus on the yen, you know, so that should be a really good good trade. If you don't want to deal with the Bank of Japan, you know, typically like EU could be a good one or GU could be a good one because it's just going to react towards the dollar. All right. Yeah, good. You got it? All right. So if we get a hawkish reaction, okay, guys, so the dollar is what we're going to look at, right? Obviously, the dollar is going to stay above 103.800, and we're going to see strength in the dollar. And we're also going to see strength in the yields, right? If we somewhat get elevated interest rate projections, right, we're going to see the yield spike up and the dollar spike up. And if that happens, other pairs is going to react to dollar strength. Like USD JPY is going to break above 150.100. We're going to see GU breaking below that support of 29,500. We're going to see EU continuing to push lower below 86.50. We're going to see AUD USD pushing lower below that support too. So whatever dollar pair you're focusing on is typically going to do the same. Okay, so when it comes to gold, we should see gold breaking below structure, breaking below 30.24. Okay, now if we get a hawkish reaction when it comes to NASDAQ, we should see NASDAQ spike lower, right? But it depends. You know, wait for market structure when it comes to equities, because remember, I'm just talking about the projection. You know, but when it comes to growth, equities might react to growth. Okay. So if growth is elevated, we're probably going to see strength in equities. All right. So just be prepared for that if you're looking at NASDAQ. Now, if we get a dovish reaction, we're going to see dollar break below 103,700 and USD JPY is going to break below 49,800. Then we're going to see pairs like AU breaking above structure, above resistance. We're going to see all these pairs break above resistance, like GU. GU has really good market structure. Gold should hold above 30.40, but be cautious on the buys because we have that overall, we see that war tensions is de-escalating, right? So the buys, be cautious with it. It could be setting up for better sales later on. Equities, we want to see US 30 stay above 41,900, and then we want to see NASDAQ stay above 19,730. Okay, so that's what's going to happen if we get a dovish reaction. Yeah, like GU, like price action on GU looks really good, but we also have the Bank of Japan, Bank of England rate decision. I believe it's tomorrow. So yeah, this should be good. It should be really good. And just a caveat: if you guys are trading like GJ, it's going to be reactive. The yen is going to do the opposite of the yields. So if we get like stronger dollars, stronger yields, it's going to weaken the yen, right? So we're going to see like GJ, for instance, is going to push higher due to a weaker yen, you know, because if it does the opposite of dollar to yields, if we see stronger dollar, if we see, if we get a weaker dollar and weaker yields, right, we're going to see GJ break lower. So that's how, like, if you focus in on GJ. All right, guys. Everybody's good. Just put a 1 in the chat if you're good. If you got questions, now is the time to ask. And then after this, like at 2:30 is going to be the it's going to be the actual the press conference, and we're going to watch that together. The press conference. Can you also look at USD outlook on and yeah, like the dollar, like if you're looking at USD Swiss, the dollar is going to be the main focus. So if the dollar gains strength, USD Swiss push higher. If the dollar pushes lower, you know, USD Swiss will go weaker. Yeah, a pause is already expected, so it's not enough. So but if we see a pause, it has to be like the projections with the pause. Like this is what's going to be like if we get a cut, right? Say if they cut 25 basis points and it surprises us, just remember that. So if we see that the so if we see currently, one second, guys. So if we see that this number is lower than 44.38, we see its number lower. That's a cut. So that's going to be weaker dollar, stronger equities. All right. If it's a pause, we have to focus on the dot plot. So if the dot plot is if the dot plot is lower, right, that's going to be more dovish. So like you said, what if a dovish pause, that's going to be the pause is the rates staying the same. The dovishness is going to be because the projections of interest rates are expecting more rate cuts. Then we're going to see weaker dollar, stronger equities. Okay. If we see a pause, but the dot plot, the projections remain the same, or we see a bit of green in here, right? We see that it increases. The markets may take it as a pause, like a hawkish pause. Then we could see stronger dollar, weaker equities. Okay. But remember, when you trade in equities, it's more about growth. So if growth is still stronger with that hawkish pause, equities may rise from that. Could you explain brief on the Fed dot plot? It's confusing. All it is just future, all the Fed members, their expectations of where rates is going to go for that year. That's all that it is. So are they expecting more like rates to be lower or higher for that year moving forward? So this was last year's December's projections. So now they're expecting the projections to be lower or higher. That's all that it is. How many points does FOMC? We don't know that. You know, like it's going to be pretty hectic. Imagine the moves like we got when it happened with a 50. Yeah, exactly. So if we get like something unexpected, yeah, it's a possibility we could get a really like we could get a real big move. You know, it's a possibility, you know, but hopefully I'm expecting today to be I'm kind of expecting today to be more of a dud. You know, like I don't want it to be, but I'm expecting it to be more of a dud, you know, just to throw that out there. Could you guys also could you see the headlines to the right? All right. So that's what we're gonna read when the rates actually come out. I mean, just look at it. Just wait for breaks of structure. Just draw it out yourself. And it's going to be tough. Like if you're trading equities, it's going to be tough. I'm telling you, because I have a good feeling that if you're trading equities, the focus is going to be on projections. It's going to be on like growth numbers. That's going to be the real focus. But typically, I don't think I can't see Powell actually coming out and saying that he sees I don't see him really coming out and seeing weaker growth. I don't think he's going to do that. It wouldn't make sense, you know. So that's one of the reasons why I don't really expect that. And just remember, guys, you know, this is going to be volatile. So if you don't want to trade this event, makes total sense. All right. It's okay to not trade this event if you don't want to. It's just what I care about more is that you guys are learning, you know, like you understand what's going on. And that's more important because there's going to be plenty of rate decisions moving forward. That's going to be a lot easier than like what's going on now. Like pretty much after probably May, not April. Yeah, it's about an 80 to 90% chance of a hold. Because after April, like probably after May is where we're going to really understand if interest, like how tariffs is impacting the economy and economic data. So then hopefully at that time, you know, trading events is going to be a lot better. Yeah, if they cut rates by surprise, oh yeah, best believe it's going to be fucking wild. You know, the thing is it's going to be hard to take advantage of it because I expect you to take scalps. So if we get a good opportunity for this event, take a scalp. You know, like take it, grab your pips, get out because markets is more likely to recover because we're going to focus on yeah, exactly. Take a scalp because the markets may recover because we're going to focus on the rate decision on the press conference. And the markets want to force the Feds to cut rates. So it may be a dud because of that. The markets don't believe the Feds right now. All right, we got 24 seconds. So just remember, like how everything comes out, I would try to let you guys know. And remember, I'm not a robot, so I'm gonna have to read through everything. But we got to look at the projections to get an idea, okay? And the moves might be so quick, you probably won't be able to take advantage. 5, 4, 3, 2, 1. All right, so the projections did come in lower, which is great. So this is a good sign for a weaker dollar, okay? So right now, we're seeing that dollar weakness come in play. All right, which is a good sign. Now we're seeing equities push up higher. So remember, like not all of them came out lower. All right. But this is a good sign. We got to pause, and then we got the dovishness that we wanted. So now let me look at pretty much the projections. Yeah, they see economic growth slowing. So that, remember, they see economic growth slowing, right, in 2025, and inflation remaining further above 2% target. Kind of mixed, okay? So growth, that's bad for equities, right? Lower growth is bad for equities. So wait for breaks of structure to be confident in the direction. I'm in USD JPY sells. Now looking at the dollar weakness is really good. Equities right now, this is a dovish reaction right now. But let me pay attention to, I want to see more about growth. Inflation remains somewhat elevated. That's the same. Like most likely, this is the reaction is from the dot plot. So what I'm going to do is I'm going to break even. All right, I'm going to just break even right now. I expect the moves to recover, right? All right, good job, dude. You made 600. Good job. I expect the moves to recover. This is the reaction because of the dot plot. But this doesn't show more than 3 rate cuts. Okay. So we could just see the moves recover because of that. So that's why I'm saying take your scalps, call it. Because we got the dovish reaction, but now we have to see if we're going to get more than 3 rate cuts. And it's a possibility we won't see that. All right. So just take your scalps, but then call it. All right. Make sense, guys? You just closed? Good job. Yeah, as you can see here, it's pretty fucked up, but I got a somewhat of a good entry. Up 13 pips. Got somewhat of a good entry. But you can see right here, they priced in 5.6 basis point in cuts this year after the Feds hold steady. So remember, they're cutting rates by 25, right? So 25, that's 50. So 5.6, that's just showing 2 rate cuts. To me, like, I don't think I feel like that even though we got a weaker dollar, I got in dollar strength. But just seeing that statement right here, it's not overly dovish. You get what I'm saying? It's only still 2 rate cuts. So this is the reactions I expect for now. But then, yeah, I'm gonna just take profit. But I expect the markets to recover. Okay, because it's not showing 3 or more rate cuts. Okay, so that's the problem. Now we have to focus on pretty much like the dollar. I guess use me as a guideline. If y'all want to stay on UJ, stay in it, but protect your positions, right? Because if the shit reverses, I don't want you to take a unnecessary loss. All right, but just stay in a position if you choose to. But the fact right here is that the markets is pricing in still 2 rate cuts. All right, so now it increased. So now you can see it came in at 6.3. So now that's probably going to cause more dollar weakness. So if it's above a 75% chance or 80, right? That's what we want. We want to see the expectations of rate cuts higher, at least 3 rate cuts or more. So it's a possibility, right, that we could see dollar still push lower. But doesn't make sense, like guys, it doesn't make sense. Even if you didn't take a trade, right, doesn't make sense. But this is why I traded UJ, because it's a lot easier. Because now if I show you guys what the yen is doing, right, just right here in the middle, you see the yen gain strength from that event. So that's why like UJ is good for that. So it makes it a lot easier. You took gold. Yeah, gold pushed higher. You see how gold pushed higher after the event, after, weaker dollar, weaker yields. But just remember, like gold, I don't expect the buys to be long term. I still expect gold to consolidate. Even today, we just had positive headlines from Zelensky and Trump, right, about that ceasefire negotiation. So I think gold would consolidate more. If UJ continues to drop, fucking punch air. Fucking punch air. Like, god damn, I should have held it. Like, the shit came in afterwards, was like, because I was focusing on this. I was like, let me take my scalp. I told you guys take scalps though. So, but dollars moves a lot better because currencies react better to interest rates. All right, make sense? Currencies just react better towards interest rates. Equities, it's more complicated because interest rates, yeah, but then it's also growth expectations. And as you can see, like because I know you guys bought from the event, which is risky as fuck, but we still didn't have no break of structure. So that's the problem. No breaks of structure yet. For future reference, how do I know when to close a position? I feel like I left so much on the table. That's always going to be a problem. Knowing when to close, leaving so much on the table, that's always going to be a problem. Rather, if you have 100, if you got a small account and you make $100, and then you're like, damn, I could have made $3. It's going to be the same thing as if you got a $10,000 account and you're up $5,000. You're like, damn, I could have made $8,000 or 10. It's the same thing if you have $1 million account and you got like 250,000 and you're like, damn, this could have been a $500,000. You're going to always feel the same way. It's just don't let greed impact you. Like I took profit at this area structure on UJ, so yeah, I left a lot out of the table, but I'm always satisfied with the win. Just be satisfied with the win. And worst case scenario is like whatever tool could help you, right? If you could take partials, like take 50% off the table, like leave the rest at break even, or just like take 75% off the table and then leave the rest where it is so you could get extra. Or it really depends if all of this came in red, right? Like if everything came in red, I would say hold the trade, right? Because it's a no-brainer. So it also depends on the data that you're trading. But if you want to just you never know exactly where to take profit. You would never know. But yeah, you could do little tips and things that you could do to help you with that. Like taking partials and then leaving a runner, then maybe you could get more. So at least worst case scenario, you still won the trade. I always say at least break even, let it be. And then focus on your take profit areas. So if you're trading like NASDAQ, you hit that area of resistance, that's TP1. Then what is your second TB? It could be 19,800, right? Yeah, exactly. Even TP1 and break even never fails, like what Collage says. It's like you're always going to feel that way of, damn, I could have had more. You're always going to feel that way. You always will. It doesn't matter how much you make. It's never enough. That's the problem with money. I don't want you to feel that way because that's gambling. Just be strategic with your planning, execute the trade. If you have a take profit like TP1, TP2, just hit those targets. Worst case, always leave it at break even and see where it could go. Or if your stops is below structure, just leave it and just let the trade go, right? Don't adjust it. Just let it go. So it's just figure out what works for you, because what may work for somebody else may not work for you. Like looking at UJ continue to drop, I'm like, fuck, I want to throw my mic. But I got the win. Everything that I planned, everything that I said, executed, right? This was pretty easy for direction. Most of y'all took the gold buys. Some of you took equity buys, right? If you took advantage, look at GU, all the dollar pairs executed, right? Just follow the red arrow. Everything is following, right? So the difference is on holding trades. It all depends. Everybody is different. Use it as a guide. And how you want to stay in a trade long enough is completely up to you. But break even is never wrong, man. Breaking even is never a bad thing. But any questions now, guys? Next, we're going to wait for Jerome Powell to completely say nothing, right? That's what we're going to wait for next, is for him to say nothing. And just waste our time like for pretty much an hour. Like that's what we're gonna wait for next. Instead of taking my profit, buying some more Pokemon. Yeah, whatever works for you, man. Hell yeah. Good job though. Yeah, Jerome Powell gonna talk in circles. Yeah. Like let's see what kind of tie he fucking wears, right? Or if he comes in with no glasses, you already know it's a wrap. But again, guys, makes sense. Like put a one in the chat if it makes sense. If you guys have any questions or still like lost, this is the perfect time to ask. Don't DM me later like, oh, I'm kind of confused, because like it's good to ask the question now while it's live so I can help you understand it. Yeah, we already got the reaction. You know, it does look good. Like this to me looks really good. Yeah, like now when he speaks, the problem is like Powell's been doing this for so fucking long that he's gonna say a hawkish comment and then right after that a dovish comment. So it's gonna be a pain in the ass trading when he speaks. But what we need to pay attention to now when he speaks is, damn, UJ is fucking melting. That's crazy. But now what we want to pay attention to when he speaks, right, is obviously his projections on forward rates, right? So you want to see if he stays that dovish tone, like, yeah, inflation is heading to target. We know he's going to say that. We know that he's going to say uncertainty regarding Trump's policy. We know he's going to say that. But the dot plot, right? We need to have him it depends on the questions too for the Q&As. If they ask some good questions, we should have a really good trading day. But if they ask some bullshit that they know that he's not going to answer to it, it's just going to be a waste of time. So trading while he's speaking is very tough. Yeah, what Wayne said, I'm going to close before he speaks. Yeah, exactly, Wayne. I'd agree. But I think right now is the move. You know, it's a reason if equities don't break structure, right, is a reason for that. So you don't want it to pull back and then reverse on you, because now when he speaks is about what he thinks about growth. And remember, I don't think he's going to say anything negative about growth. So that's my expectation. I don't think he's going to say anything negative about growth. I think he's going to he's going to confirm no recession on the radar. But let me look at the growth projections real quick. What trades are you guys in? Did you guys take profit? Y'all in trades y'all won? Like what did y'all guys do so far? Fucking UJ. God damn, man. That was easy. That was pretty easy. Gold buys, US 30 buys. Yeah, good job. UJ and EU. Good job with that. You still in GU? I like that too. If we continue to get a weaker dollar, I would like to hold GU buys. If we see this continue. If you could get up substantially, Terrence, with this, I like the idea of the Bank of England giving us a hawkish pause as well. Like I think that's what's going to happen. So I like the idea of pound strength, but it just depends on what Jerome Powell says. But I like that idea too. Yeah, gold was like candy. Yeah, that was pretty easy. Good job. You still in UJ? Oh fuck, man, fucking awesome. Yeah, good job, guys. Yeah, because it's kind of tough. Like trying to. Like for me is like a little tougher. Like I'm like, let me just take my profit and then help you guys out more, because like I don't want to fucking mess up. Yeah, so I got it now. And remember, Trump likes to fuck with the markets. So hopefully he don't. I mean, this is what he wants. So I think this is good. Even if Trump speaks, I think this is what he wants. I can't see him. He probably would say like some shit like Powell should have cut rates today. Like I'm expecting Trump to say something like that, you know, like he's going to be pretty, based on Trump saying, yeah, exactly. I feel like this is what he wants though. But pretty much after the press conference, be prepared for him to tweet some shit. Just be prepared for it. He's going to tweet some shit. All right. I think I got a better one here. Yeah, I'm just putting the screenshots of all the data so you guys could further understand like what the markets are really looking at. And then got to post a press conference so we could watch this live. A pause, is it always hawkish? Good question, but it depends on the forward. Not really. It depends. Like right away, mentally, yes, right. Only if, the markets was projecting a cut. So say before the meeting, the markets is projecting a 25 basis point cut, and then if they leave rates the same, then it would be hawkish because it's going against the expectations. Okay. But if the markets is already expecting a pause and it comes out as a pause, it's always about forward guidance. That's what's going to be the direction. So an example, if they're expecting a cut, right, an 80% chance of a cut. So pretty much anything above 70, like I would say anything above 70% is kind of the direction the market is expecting it to go. So if it's a 75% or above, they're expecting a cut and then they pause rates, then expect a hawkish reaction. So say if it's like a 60% chance of a cut, like, or say if it's a 60% chance of a pause, and then they pause rates, then it's most likely still will be a hawkish reaction because it's close to 50-50. Get it? So if that number is closer to 50, like I would say like 65 and below, then whatever they do, if they hike, pause, or cut rates, is going to be a surprise. But if it's anything above like 75% chance, then most likely if they do exactly what they expected, there's no reaction. All right, so hopefully that helps. All right, so now we're going to look at this. So this was December's. So remember, like, look at the numbers right here for 2025. Like this was December's. This was the previous. So this is why from December we got that hawkish reaction in the markets. So now compare that to now. Look at 2025. So they're expecting like the first half of the year, right, to stay pausing, but now more members are projecting more cuts, like for the rest of the year. This year is kind of more of a pause. So they're slow, like a slow guidance. But moving forward, look at 2026 compared to 2026. You see the difference, 27 compared to 27, right? So we're seeing more members in the longer run. You can see that more members are approaching, like they're expecting it to go lower. So there's more dots pushing lower. So all of this is Fed members with their projections of rates. So I don't know how they do it, but they're kind of like pointing out where they expect rates to be for the end of that year. So more members are pointing towards rates to be lower. So that's why we got this reaction, right? So now you can see this is March, right? So just looking at the projection. So December's projection, we see that GDP, they was expecting it at 2.1. So now we're expecting it to be lower. Unemployment, they expect unemployment to rise. They always get unemployment wrong, but that's also okay. They're expecting PCE to rise a bit this year, right? And they're expecting inflation to rise this year, but then they also expecting the Fed fund rate to remain the same. And then also in 26, you can see they're still expecting GDP to rise a bit, unemployment to stay elevated, PCE to actually lower. So not much as a change, right, overall. But look at the long run, still the same. We're not really seeing much difference, from the projections. But this is expected because economic data could always change that. So this is to tell you guys that's why focusing on data is what really matters. This is what changed those projections because this could change. They got unemployment wrong in December, right? Unemployment actually was stronger. We just had a recent print when unemployment went to 4.3%. So it depends. So obviously weaker growth and all of that would change this, but at least you guys could get the picture, right? So you see why they're making that projection, but everything was the same besides this. This is what the markets is reacting to. So at least you guys could get a better idea. Now we got the press conference. So reactions still the same, right? All right. So questions, was it as expected? Pretty much. The dot plot came out lower, but the projections was still close. That's why we didn't get those real big reactions in the markets. But the yields, look at the yields. It just dropped. So that's a good sign. Weaker. I didn't draw the red arrow, but the yields did drop. With them expecting inflation to rise still, but still seeing the rates to eventually go down over the next couple of years, will the only way the markets react to inflation being sticky if it comes out higher than expected? I personally think that depending on what happens with tariffs is going to be the main because just like the Bank of Canada, right? They're expecting inflation to rise, but they're expecting inflation is still lower, right? But the only reason they temporarily expecting higher inflation is because of the uncertainty of tariffs. So that is unexpected. They're expecting it to be temporary. So if he confirms it, because that's what the chair of the Bank of Canada said, is that the rise of inflation may happen, but it's only temporary. So if we see that it's temporary, markets may not care about that because if tariffs becomes a longer term issue, then that's when it's going to be a problem, right? But if we see that it's temporary, markets may not react to that higher inflation print because they know it's not natural. It's just coming from an event, right? So that's why that lower inflation number rising probably won't matter as much because what he's going to say is like, yeah, we're going to see inflation tick up a bit, but it's not going to get out of control or something like that. He may use different words, but he's going to say, yeah, we could expect higher inflation, right? That's supposed to strengthen the dollar, but he said, well, the higher inflation is because of the uncertainty. It's because of the businesses. They're scared, right? So they're going to increase the prices of their goods. When it comes to trade, like if they get less product, they increase the prices of their products. The business is what's affecting high inflation. So it's temporary. But if they expect it to be long-term, then that's the problem. That's where we will see a hawkish reaction. But if that was the case, if we was expecting that, if they was really concerned about higher inflation, the dot plot won't be like this. The dot plot would still be like December. It would be less. They expect less rate cuts for 2026, pretty much. So I don't think they expect it to be long term. How did I learn all this? Just like paying attention to like YouTube, following people that focus on fundamentals. Pretty much is nobody on Instagram. Go on Twitter, follow analysts on Twitter. It's usually like people, usually the people in Europe, they follow it a lot more. A lot of like American traders they only focus on technicals. Yeah, I know. I'm not trying to look at UJ. Fuck, man, that shit's crazy. I'm just afraid to push it down, man. Yeah, that shit is gone. Damn. I know Wayne, you still in UJ, right? Yeah, good job, dude. Yeah, from the breaker structure already up. Yeah, that was a great trade. Trad, I know. But good job, Trad. You've been doing really good, man. Yeah, exactly. Like the fundamentals help with the direction. Like you see with the technicals, it's like you know how to enter the trades with your technicals. Like technicals is different for everybody. You know how to enter the trade. But this is what I mean. When it comes to fundamentals, it's like we understood that this was a weaker dollar. So it's like you can't debate that, right? So that's something that we all could agree on. It's like what happened right now supported stronger dollar, a weaker dollar, stronger equities, right? So that's something that we there was no debate. But when it comes to how you enter the trade, everybody's going to have a different opinion on their entry, on what they look for, right? So that's the difference between technicals and fundamentals. It's right that when it comes to that, you should understand the direction. So there's a reason, like right now, if somebody would have been buying the dollar, they'd have been fucked, right? Like I guarantee, like just from technicals alone, somebody bought the dollar when this happened. Somebody was in sales on like USD, Euro USD, right? Right now, somebody is selling in sales on gold, right? So that's what I mean. Like the technicals, you could get those breaks of structure, but when dollar broke above, and then we would have had a hawkish outlook. Dollar would have continued to rise, right? So it makes sense. So the technicals would have followed the reason behind it. But exactly, technical subjective, fundamentals object. Yeah, So, but there's a time if technicals is the only thing that's important to the markets, right? There's no fundamental outlooks, right? There's just only technicals that you have to focus on. It is okay, to just trade technicals, but the way I like to tell myself is that it's subjective. Like what you said, it's 50-50. So if you lose a trade, there's no like, how could I back test this to figure it out? It's just that, hey, there's a 50% chance you will win the trade. There's a 50% chance you may lose the trade because it all depends on your entry, your stop loss, and your take profit. Because you probably could be right for 15 pips, but you're probably wrong expecting 50 pips out of it. You probably are right for 5 to 8 pips, but you're probably wrong from expecting 20 pips out of the move. So that's the problem, and most of you guys get it. So I don't have to really explain it. Yeah, like these rate decisions, somebody definitely like, they blow their account. That's why prop firms don't let you trade it. Yeah, exactly. Like you can win one trade, like what he says, like exact same technical analysis trade can win one time and lose the next. Yeah. Like an example, like somebody could buy the dollar here and then it reverses. But you did that yesterday and it continued. It's always reasons that matters behind it for the move to continue or not. It's always reasons behind it. But that's where risk management comes in place. Risk management is key. You guys on YouTube, I'm talking to my chat, my group. So if you guys, I read the messages for you too. If y'all have questions, y'all can answer it too. Y'all can ask too. We're waiting for 2:30 for Jerome Powell to speak. We listen to it together, and we see if we get continuations. It's looking like equities could be a good like. I like the tradable opportunities for GU if we continue to get a weaker dollar. If he comes out and says something hawkish, right, then possibly taking UJ buys would be a good bet. But looking at price action, it's looking like moves may be recovering a bit soon. If you had to put if you had to put why trades today won in a sentence or two, would you how would you say it? Fuck. If you had to put why trades today won in a sentence or two, how would you say it? Uh, like how to quickly put how the trades react, like how we won in the trades today was because of the dot plot. The dot plot came out, expectations and the dot plot of further rates came out lower. Yeah, that's what it was. It's just the dot plot. All right, he looked normal, so probably going to be a shit meeting. If he had like a red tie, you know, you could expect him to be dovish or some shit.
People. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
He's just going to reread.
We also made the technical
can you guys
decision
hear
to
it?
slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected.
Is it better like that?
And to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years.
You see, so far what he's saying is supportive.
Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2%
and then he's saying the labor markets
goal.
is not a source of inflationary
Estimates
pressures, which
based
we
on the
already
Consumer
know.
Price
Labor is
Index
about
and
growth.
other data indicate that
So
total PCE
overall,
prices rose
still good for the
2.5%
equity markets.
over
That's
the
why
12
you see
months
that
ending in
NASDAQ is
February,
pushing higher.
and that
That's why you see
excluding the
US 30s
volatile
pushing
food and
higher.
energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs
So
as
you
a
see,
driving
it says
factor.
inflation expectations has recently moved
Beyond
up
the
with
next year or
tariffs
so,
as
however,
the driving
most
factor.
measures of
See, that's what I
longer-term
said.
expectations remain
So
consistent with our
tariffs is what's
2%
really
inflation
driving
goal.
inflation. It's not monetary
The median
policy.
projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal
Long-term
funds rate
inflation
at 4.25
expectations
to
is still with the
4.5%.
2% goal.
Looking
So
ahead,
that,
the new
like, to me,
administration
is like,
in
yeah,
the
this is
process
a
of implementing significant policy
so
changes
far
in
dovish
4
reaction.
distinct areas.
Definitely good for a dovish
Trade,
reaction.
immigration, fiscal policy, and
Only price
regulation.
action I really like
It is
is
the net effect of these
is,
policy changes that will
GU
matter for the
really.
economy and for the path of monetary policy. While there have been recent
I like
developments in some
GU
of these
that is
areas,
holding above
especially trade
structure.
policy, uncertainty around the changes
But we need to
and
see
their
the
effects on
yields
the
continue to
economic
push
outlook
lower.
is high.
You know, if we can see the
As we
yields
parse
push
the
lower,
incoming information,
like I like GU
we're
for a
focused
good
on
buy.
separating
You know,
the signal
GU is the
from
only
noise
thing that's
as
showing
the
good
outlook
structure.
evolves.
But
As we
you
say
know,
in our
he's still
statement,
talking, so
in
it's risky.
considering the extent
Regardless
and
what you
timing
do
of
is
additional
risky.
adjustments
But
to the
so far
target
it's
range
good.
for the federal funds rate,
But you see, we do not
the
need to be
committee
in a
will
hurry.
assess incoming data,
So
the evolving
that
outlook, and the balance of
is-
risks.
That to me
We do
is
not
neutral.
need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity.
Greater clarity. That's just data
In
dependent.
our SEP,
So that's the
FOMC
problem with trading when
participants
he's
wrote down their
live. But the
individual
Q&A is what's going to
assessments
be
of an
important.
appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course.
Uncertainty is usually
As the
elevated,
economy evolves,
you know,
we will
so
adjust our policy
yeah, just be
stance
cautious
in a
right now,
manner
but
that best
overall,
promotes
markets
our
are still
maximum employment
dovish.
and price stability goals.
If the economy remains strong,
If the economy remains strong,
we can
inflation
maintain
does not
policy
continue
restraints
to
for
move
lower.
sustainably toward 2%,
that means
we can
that
maintain policy restraint for longer.
that means they could
If the
stay
labor market
in
were to
that
weaken
gradual
unexpectedly,
pause
or
approach
inflation were to fall
longer.
more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets.
I felt like this is
Beginning
what
in April,
the
monthly
markets
cap on
wanted to do
Treasury
to the
redemptions
dollar
will be lowered
was
from $25 billion
they wanted to
$5
push the
billion.
dollar lower, right? This is what
Consistent with
the
committee's
markets
intention to
wanted.
hold primarily
So
Treasury
this is why the
securities in
dollar is
longer
still
run.
dropping. This
We
is
are leaving
definitely
the
good
cap
for the
on
dollar,
agency
but overall,
securities
still dovish
unchanged.
overall.
This action has no implications for our intended stance of monetary policy and should not affect the size of our
Anybody
balance
is
sheet
still in
over the medium
GU?
term.
I think GU was really good if you
The
got
committee
in
also
already.
continued its discussions
Really a
as
good
part of
trade.
our 5-year review of our monetary policy
But now
framework.
Q&A is going to
At this
be
meeting, we
the
focused
next
on labor
focus.
market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters.
Right now it's
Thanks for your
Q&A.
time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
And you guys are still in
Okay,
gold.
so
Finally,
how
gold
much of it
broke
is,
structure,
is
but I
tariff?
think it was
So
set
let me
up for
say
better
that it is,
sales later on in the day.
Going to be
but
very difficult
if you guys
to
are still
have
in
a
gold, like
precise
good job, man.
assessment
That
of
shit
how much
really
of
broke
inflation is
structure.
coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best
So he
possible
finally
way to
confirmed
separate
tariffs
non-tariff
is a
inflation
problem.
from tariff inflation. In terms
Tariff
of
inflation.
the,
That's what I was saying
the-
earlier.
your-
That's what he's
your
going to
sort of,
blame a
looking
lot
through
of
question.
inflation uncertainty.
Too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to
So
look
if
through
he stays
inflation.
this
If it's going
route,
to go
right,
away quickly
that's
without
going to
action
be
by
that could
us, if it's
cause a
transitory,
risk-off
and
market,
that can be the
and it
case
could
in the
cause a
case
hawkish
of
reaction.
tariff
We could see
inflation.
the dollar
I
recover,
think
and we
that
could
would
see bearish
depend on,
downside just because he's
the
blaming it on
tariff
tariffs.
Inflation moving through fairly
Right?
quickly. and
So
would depend
that's
critically
that's
as well
how.
on
This is why
inflation
when he
expectations
talks,
being well
and it's the
anchored,
Q&A.
longer-term
Now we
inflation
can see how the
expectations
markets
being well
react to
anchored.
what he says right away.
I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that we're going to have to see how things
you don't wanna
actually
answer it.
work out. And the fact that there wasn't much change.
No,
I think
because
that's
uncertainty
partly
should still be
because,
good for gold.
You know, you see weaker growth but higher inflation. They kind of offset.
You close
And
gold
also,
now, good
frankly,
job.
A little bit of inertia.
If he would have
when
said,
it
"Yeah,
comes
we're going back
changing
to
something in this
transitory,"
highly
that would have
uncertain
been the
environment,
stronger
you're-
dollar,
you know,
weaker
I think
equities.
There's a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and you know, short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer you know, questionnaires are pointing to tariffs about that.
If you're looking at equities, it's about growth
In the survey world, if
in
you
the
look
labor market.
a little further out, you really don't see much in the way of an increase. Longer term inflation.
Longer term,
inflation
he's expecting
expectations are
inflation to
mostly
still
aligned
lower.
if you
It's
look
just
at the
short
New
term
York,
because of
for example.
tariffs.
Then
So
you have
this is
market-based,
good.
and
This is
it's
to
the
me
same
still a
pattern,
hawkish,
you know,
a dovish
people in
reaction,
Markets are pricing in
which is really good for
break-evens.
weaker
Some higher
dollar,
inflation
stronger
over the
equities.
next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5 year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, you know, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. You know, we do see pretty solid hard data still.
Yeah, you seeing
So
how the
growth
reactions are
looks
now?
like it's,
Yeah,
maybe
like
moderating
now
a bit,
GU was
consumer
probably the
spending
best option
moderating a
from a
bit, but
technical
still at a solid
perspective.
pace.
GU had better price
Unemployment's
action.
4.1%.
Yeah,
Job
overall,
creation
still
most
same
recently has
tone.
been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But you know, given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
Yeah, good job,
So
guys.
I do
Yeah, everything
like
is still
that
the same.
definition
Nothing
a lot. In
changed.
fact, I used
Definitely,
it, at the
he's
recent,
he's
conference
kind
where I
of
spoke. So
confirming to the
I
markets
think a world
that
where people can make their daily economic decisions.
I put the
and
dot plot
businesses, and
info
they're not
in
having to
the
think
central banks
about the
tab. So we go to
possibility of
central banks,
significantly
U.S.
high
Fed, it's
inflation.
all
We know
there.
inflation
I'll
will bounce
update
around.
I'll
That's-
update all this
that
over
is
the
price
weekend.
stability. You know, I
But
think
so
we're
far, he's
getting
still
closer
confirming
and
to the
closer
markets,
to
like,
that. I
expect
wouldn't say
lower
we were at
inflation.
that.
We're still in that
Inflation was running
pace.
around 2.5% for
So
some
this
time.
is
I
a
do think
different
with the
projection
arrival of
from
the tariff
December. He's
inflation,
more dovish.
further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do
Y'all still in NASDAQ?
In 26.
Like
and then
GU was
down
a
to
good
2 by 27, of course,
opportunity.
highly uncertain. So
Everything really
I
followed.
see
The yields, you see that the
progress
yields in the
having
bottom
been
left
made
still
toward
pushing
that,
lower.
and then progress in the future. I think
Like
that
everything is
progress
still
probably delayed
signaling
for the
that
time
dovish
being.
reaction.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment pretty close to its natural level. But the hiring rate is
So
quite
just
low.
be cautious about
So
this
is the
answer.
layoff
Hold on.
rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is,
we see
which
the
way
dollar
does that break?
recovering right
If we
now.
were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because
Higher rate
people,
and layoffs are both low. A
it's not
meaningful
a big
increase in
hiring
layoffs could
market.
probably translate to
We've been
quicker
watching that,
unemployment. So
and
that's
it's just
bad
not
for
in
the job
data.
market.
It hasn't happened. What we've had is a low firing situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's
But
healthy
policy
levels
can
of
move
job
in a
creation,
direction we
too.
need is
So
very
overall,
dovish.
It's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area. But at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with. It's either noise, and it'll come back.
Yeah, you guys have
and
any
that's very
questions so
possible
far?
too,
Like,
but
so,
if it is
like, I
persistent,
like the
then it must be
direction,
to do with people
but trading
buying
while
ahead
he's
of
speaking,
tariffs or raising prices
overall
ahead of
to me,
tariffs
he's
and things
still
like
very
that.
dovish.
Those
Like, he's
kinds
not
of
really
things happen,
changing
and
his
very, very
stance.
hard to capture.
We understand
because so
that
much of it is
tariffs is
indirect.
what's causing
A great
short-term
example is,
uncertainty.
their
But
washing
other than
machines were
that,
tariffed in
everything
the
still
last
signals
round
this
of
dovish
tariffs,
reaction of further
and
rate
prices
cuts to
went up,
come.
but prices
That's what's
also
really
went up
happening right now.
on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because you
pandemic.
could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, you know, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy.
Do you think G will continue to go up, or it's better to wait? It depends on the pound, because the pound right now is still pretty flat for the session, as you can see in the top right.
Necessary, you don't want to do it in real time.
He has mentioned
as we know,
tariffs
it's hard
at
to
yeah,
make that
10 times
judgment.
exactly. I like
So-
GU still
and
because
we're well
it depends on where you
aware,
enter. Like if you
know,
enter
of
at
what
the break of
happened, obviously,
structure,
with
worst case is you should still be at break even.
But, I mean, we
if
have
you're
to
trying
look
to
at
enter
this,
at those highs,
as,
it's going to be risky
it's a different
because
situation. There's
you could deal with a
differences in
pullback, but as
similarities.
long as price stay
it's a
above
different time.
29,800,
We
like you're
haven't
good.
had real price stability
But if we see a
fully
big retracement,
reestablished
you don't
yet,
want to
and
be
we have to
trying
keep that
to
in mind.
expect a
And,
break and a retest. You know, like you don't want to expect
we
that.
also have, we hear that people are very
Like if you
reluctant to
entered
take
already,
on,
like this is a good idea to either take profits or break
allow
even.
prices to go up at the same time. We
But
hear that
if we
businesses
see,
are intending to
like
pass
if you
many
see
of
it
these
pull
prices
back,
through. So
you
it's hard
probably
see
don't
how
want to
this is
try to
gonna work
buy
out.
it because that's the market's probably recovering.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability, and we have to balance those. And,
Yeah, it's okay to wait and be
you know, there
patient,
can be
because your
situations in
entry
which
is
they're
what's
intention,
important. You know,
right?
you
And
don't
we
want
have
to
actually
enter
have a
like
provision
EU.
in
You're
our-
entering
in
at
our, consensus statement
91.40,
that says
right?
what
You don't
we
want
should
to
do in
enter
that
at the
case. That's a very
highs. Your
challenging,
the best entry was
you know,
probably right
situation
here
for any central
at
bank, and certainly for
88.70
us.
once it started
And so what
breaking
we say
above
that we'll
structure,
do is we'll
right? So
look
that
how far
everything
each of
still
those
remained
two
the same.
goals is
So you should
each
have
of
like
those two
entered
measures is from its
when
goal.
the market started
And then we'll ask
reacting to the
how
headlines,
long we think
right? So
it might
now
take to get
you
back
have
to
a
the
better
goal for each
chance
of
at
them.
being
We'll
at
make a
break
judgment
even
because
or
our,
getting
you know,
out the
our
trade
tools
early
work in
if he
one
says
direction
something
or either
opposite.
tightening or
But
loosening.
trying to get in
So it's a very challenging situation.
later
We
than
say
expected,
we don't have that situation
like
right
market's
now.
already
That's
made
not
its move.
what the-
So
that's
now
not
it's
where
like
the economy is at
50-50
all.
if you're in at
It's
a
also
high.
not where
You
the
get what I'm saying?
forecast is. I
So
don't know any
yes,
mainstream
it's a
forecast that
possibility. Like
really
if you enter
shows
in Nasdaq
significant
at this high,
problems like
that it will continue to push higher. But then there's also a 50% chance
just to
it'll
follow up,
recover.
yesterday,
So if
the,
you don't want to deal with
UCLA
that risk,
Anderson
be
forecast
patient.
said
But if you're comfortable with the risk, then
high
take it.
probability of a recession. Where
But
do
right
you
now,
stand
it's
on
like the move's
whether or not
already
the
happened,
slowdown you're
you
seeing
know?
creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional probability, possibility of a recession. It might be
All right, do you
broadly
think,
in the range of 1 in 4.
do you think with the news
at
just
any
came out,
time, if you look back through the years,
markets
it could be within
can
12 months of 1 in 4
continue to
chance of a
trend
recession.
structure until
So the
next
question
week,
is whether that,
meaning that you see sales. No,
whether
like
this current
because
situation,
this is what's important now.
those
Like
possibilities
everything
are
could
elevated.
change.
I will say this:
5 minutes from
we
now,
don't- we
like
don't make
probably
such a
next hour
forecast.
from
If you
now,
look
because
at
we have
outside
so much shit
forecasts,
going on,
forecasters have
right? What
generally
happens if
raised
Russia
have raised
Ukraine
their
peace goes out the
possibility
window,
of a
right?
recession
So that would cause
somewhat,
the
but
dollar
still
to gain
at
strength,
relatively
right? That would
moderate
cause
levels,
equities
you
to
know,
push
still in the
weaker.
region of-
I mean,
of the
if
traditional,
you want to
because it was
test it
extremely
out,
low. If you go
enter
back
and just
2
don't
months,
move your stop loss,
people were
and let's
saying
see
that
if
the
it goes in that
likelihood of
direction.
recession was
But
extremely
there's
low.
so
So
much
has
shit
moved up,
that's
but it's not
that's
high.
impacting the markets that you could possibly get a recovery, right? Like a pullback before the markets continue.
Associated Press.
So just anticipate the
I guess
pullbacks.
last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I.
Yeah, they're not.
place
They're
a huge
answering
weight on it. I
if
think that was
Trump could fire their
ex
asses,
post,
and he's like,
story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it. We don't.
all right.
dismiss
So
data that we don't
forecasters
like.
have raised their
We
possibility of a
force
recession
ourselves to look at
somewhat,
it,
but
it
not.
is an
But it's
outlier
not
compared to
high.
Market-based.
So that's
compared
not
to
good for the
other
equity
survey-based,
markets. You know, they're increasing
assessments
their
of
recessionary stance. That's
longer-run
not good for the
inflation
markets.
expectations. So we got to keep that in mind. And
Yeah, exactly. He
and
said no.
I,
So it shows
I
that
would
the
just
Feds
say,
is a
we look
private
at- we look at
entity
all of them,
that
and, that
the
one's
presidency
kind of an
doesn't
outlier,
have
but,
no control
you know,
over. It's not up to
nonetheless,
them
we
to
take
dictate
notice of
who's
it.
in chair and not. It's not a political vote, you know, like that's how you know who runs the world.
Radio and television. There is a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And, you know, we will use our tools to foster achievement of our goals to the best we can. And, of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty. And we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, you know, in coming months, certainly over the course of this year, and we'll be.
No president nominates the chairperson, but they serve 10 years. Yeah. Yeah, exactly. That's why I like watching those videos
Siegel
on
from Washington Post. Thank you for taking our
I
questions.
got books on Greenspan. Like,
you were
you know, you
talking
want
about
to
separating
understand
the signal
how
from the
they look
noise
at
and tariff
economics,
inflation from
how they look
non-tariff
at the
inflation.
economy.
Can
It
you
kind
walk
of
us
gives
through
you an
what that
edge
looked
on what
like
to
over the last
expect,
couple
you
of
know,
months, if there were
because
specifics from
Trump is like
the
a
January
different, he's
meetings
like a
now that
different
helped
breed
you
right now when
make
it
those
comes to
distinctions?
what's
So
going
when we say
on. You
separating
know,
the
like the
signal
fact
from
that
the
he has
noise,
so much
that's just a
control,
way of saying
it's
that things
insane,
are highly uncertain,
you know.
and that, you know, you're reading about
Like Trump,
developments,
like
the
his
news is
word,
full
like
of
he's
developments
literally
of
proven
tariffs
that
being
his
put on and
his
taken
words
off
is
and things
not.
like that.
He's impacting
That's-
the
some of that
entire
is noise
world
in the
when it
sense
comes
that
to the
it's
financial.
not really telling you
When it comes to
anything.
finance,
You're trying to
insane.
extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was.
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. You know, the idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you know, you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. You know, I think we'll know. In a couple of months, we'll know whether those were, you know, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it.
But if the Democrats win control of
that's what we'll be doing.
the Congress,
we'll be doing
he
that,
would
and
be.
so will everybody else, and we'll all be trying
Yeah,
very
like-
hard to make that assessment. And you know, I'm
Because
sure
it's
we
just
will
all about
make
his.
a lot of progress on that. And we
If the
already have,
Democrats
but
would have
it's
won,
going to be a
right?
challenge.
I think what
Do
we
you
would have
have a
been
sense
worried
yet as to
about was
what,
more
in your mind, would
like
make
we
something
probably would have been in
cross
war with
from
Russia and
noise
shit
to
like
a
that.
signal, what that
But the
threshold would
tariffs
look
would have
like?
never happened.
it would
You know,
depend on what we're
so
talking about. I mean,
he was already.
obviously you're looking for.
We probably
direct
would have
evidence
continued
that
that
particular
dovish
pieces of
reaction
of
because the
inflation
only
are
reason why the
far or
uncertainty
clearly
happened
not
was because Trump came in
caused by
policy.
tariffs, for
So
example.
it would have just
Something
made
that was,
trading a lot
you know,
easier
in the
if the
service
Democrats
sector
would
that
have
was
won
far
because
away
we would have
from
just had to
anything that's
continue that
tariffed,
direction.
you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well.
But all right, guys,
which
I'm
for-
just
for
here.
some
You
time
know, like
was
he's not changing anything.
kind of our problem.
I think
Now
this
it's
is the
been
direction of the markets.
slow,
You
but
know,
it's
this is it.
definitely,
Weaker dollar,
moving down
stronger
in a very
equities.
good way.
You know, this is the direction of the
more now
markets
with
overall.
goods and to some
Yes, you
extent
can
with,
anticipate some
with
pullbacks,
non-housing
right?
services
It's possibly going to happen. But this is it. You know, don't try to look for trades afterwards. Like if you took
Thanks for
advantage of
taking
the
our
trades
questions,
now,
Chair
that's
Powell.
great.
Kelly O'Grady,
But
CBS
afterwards,
News.
you know, just
So
wait for the
consumer
next
sentiment has
opportunity. But
dipped
as of now,
dramatically, but you
this
say
is
the
what we got,
economy
a dovish
and the
reaction in the
hard
markets,
data
all
is
right?
still
So good job,
solid.
all of you guys.
What is your message
And
to
see you guys
consumers
for the
that
next one.
clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about
Good job, guys. Have a good one.